The California Gold Rush created a handful of generational fortunes and 300,000 broke miners. The average miner made $20 per day, but spent $25 per day on living costs. And after 2 years of backbreaking work in the Sierra Nevada, most went home poorer than when they started, if they made it home at all. And as a California kid, I learned this lesson in school. Some struck it rich, most died or went broke. It's an important part of the California ethos, striking, going for the big deal. I mean, my favorite football team, the San Francisco 49ers, named after the year of 1849, when the 49ers arrived en masse trying to make their fortune. But here's what our history books leave out. Most of the real estate speculators were also ruined. Real estate investors who bought San Francisco lots during the boom, they watched their portfolios crash 75% in 1857. Most went bankrupt. Many lost everything. The few who survived had three things in common. They didn't over leverage. Many bought early before peak prices. And most importantly, though they didn't realize it at the time, they'd bet on a peninsula surrounded by water and mountains. Today on the Timeless Investor Show channel, I'm going to show you why betting on migration booms is incredibly risky, why most speculators lose everything in the inevitable crash, and why the survivors are determined not really by their intelligence, but by the innate wisdom they exercise in acquiring their portfolios and the underlying supply constraints of the market they choose. Because the 2020 through 2023 Sunbelt migration boom was just the California gold rush with a different cast of characters, and it is ending the same way. These patterns don't just rhyme. They do not just rhyme. They're identical. This is why I love the study of history. It helps you to identify what is actually happening because these things repeat. And why? Because human nature doesn't change. So let me give you a scale of what happened. In 1848, San Francisco was a sleepy port town of about 1,000 people. 1 year later, 25,000 people. And by 1852, nearly 50,000 people had flooded into the city. That is some unbelievable growth metrics, right? Unbelievable. Empty lots that sold for $50 in 1847 were going for 16 grand by 1849. That's equivalent to over $500,000 in today's money. Hotel rooms rented for $1,000 per month when the average daily wage was 20 bucks. And here's something I find interesting, and we're going to delve a little bit into Freakonomics on this one, but it's something else the books tend to skip over. Gender ratios were really out of whack, as you can imagine. A bunch of kind of sweaty, dirty gold miners hustling west to make their fortune, probably leaving their wives and girlfriends behind. The gender ratios reached 12 to 1, and in some camps, 50 to 1. So as you can imagine, any woman providing services in high demand could command very premium prices. In fact, I did a little research on this. One prostitute reportedly earned $50,000 in just a few months, equivalent to roughly $1.6 million today, while the average miner made $140 per week. Within 8 blocks of downtown San Francisco, there were 100 operating brothels. Good time to be in this business. It's the same economic principle we are talking about. Don't dig for the gold, sell to the gold diggers. Supply and demand works everywhere, even in places polite society doesn't love to discuss. This was not, as I said, just a gold boom. As you can imagine, this was also one of the world's first modern real estate booms, driven by the exact same forces we see today and forces we see every single time this happens. Massive population growth, infrastructure that can't keep up, and speculative capital chasing the next big thing. That, guys, is the COVID era Sunbelt boom to a T, the exact same movie played out. Now, every migration boom, in my opinion, has three distinct groups, and the California Gold Rush is one of them. The recent Sunbelt migration, of course, is another. And understanding which group you are in determines whether you will build your wealth or you will lose it. The first are the dreamers, the miners. These were the 300,000 people who dropped everything to chase gold. They sold farms, borrowed money, traveled thousands of miles based on stories of easy riches. Most went broke fast. Why? Gold was finite, difficult to find, required enormous luck, and by 1855, the surface deposits were gone. Individual prospectors were finished. They were sold a dream that was not really realistic. But we love dreams, and we love to go for them. The second group are the operators, the infrastructure builders. While miners were digging holes, a smarter group sold them tools. These guys did pretty good. Levi Strauss, as an example, didn't pan for gold. He sold sturdy pants to miners. And Levi's is still a great company, still operating out of San Francisco. And I grew up wearing them. So, talk about success. Sam Brannan sold shovels and supplies. John Studebaker built wheelbarrows and mining equipment. All of these companies still exist in some format today. These businesses had predictable cash flows, repeat customers, and they survived when the gold ran out because the tools were still needed for farming, construction, and everything else. And they probably bet that some of these miners would stay and settle down and build roots there. But there was a third group that made a very different bet. The third group is the real estate speculators. So while everyone else chased gold, a group of investors made a different but equally risky in hindsight bet. They bought San Francisco real estate. They purchased lots before the rush, developed hotels during the boom, and built infrastructure they hoped would outlast the mining booms. William Ralston, Leland Stanford of Stanford University fame, and the Big Four railroad barons. These are the names that we remember. But we don't remember the hundreds of other speculators who bought the same lots, built the same hotels, and went bankrupt in 1857. What made the survivors different wasn't superior intelligence or better timing. Many of them did buy at peak prices. Many made leveraged bets. They were speculators, not geniuses. What made them different, in my opinion, was the market they chose. San Francisco was a natural harbor. Its position as the gateway to the goldfields, and most importantly, its geography as a peninsula surrounded by water and mountains. So here's what made the real estate play so alluring. Every gold mine needed 10 supporting businesses. Each mining camp required hotels, restaurants, saloons, banks, transportation networks, communication systems, and yes, brothels. But more importantly, the permanent infrastructure that emerged, railroads, telegraph lines, financial institutions, created lasting value that transcended the initial boom. The Transcontinental Railroad, completed in 1869, made San Francisco a permanent fixture in the American economy. Here's something critical to understand too. The California gold rush was not one boom. It was a series of brutal booms and busts. First, you had 1849 to 1853, the initial rush, the 1849 rush, for which my dear San Francisco 49ers are named after. Everyone got rich, real estate exploded. Then 1854 to 1857, the bust. Easy gold depleted, miners go broke, they leave, they die, they don't have money. Real estate crashes 75%. Most gold rush real estate speculators did not survive that crash. They went bankrupt also, lost everything, and left San Francisco. The fortunes we read about today were the survivors. Maybe 1 in 10 of the original speculators. What separated them? First, low leverage. They could hold through the crash without foreclosure. I had a podcast interview several weeks back with the legendary, to me, he's not well known, but if you haven't watched the episode, you should watch it, legendary Seattle investor Ron Dance, who has been in this business for 53 years. And I asked him, Ron, tell me about a crisis that almost killed you. And he said, there haven't been any. Which I thought, wow, good for you. That's great. He said, no, I haven't been any. And I'll tell you why, Ari. I never took as much money as the lenders wanted to give me. Never. I was always willing to settle for slightly lower returns to survive. You want to be a member of the survivorship bias class in any real estate boom, and low leverage is probably the number one way to do it. Second, early entry. Buying in 1847, 1848, before the rush meant they could survive a 75% drawdown and still be above their basis, provided they didn't recapitalize or lend against their assets with their newly created paper wealth and try to buy something else, right? Third, patient capital. family wealth, inherited land, or simply not needing liquidity for a decade. Lastly, geographic luck. And this is critical. They bet on a peninsula surrounded by water and mountains. They probably didn't fully grasp this in 1855 when San Francisco was tiny and new, but as the city grew over the next 50 years, that geography became a permanent supply constraint. So in 1858 to 1870, you had a recovery. Silver was discovered. The railroad was completed. Real estate came back, but only for the survivors who could hold through the pain. The pattern repeats in every cycle of this boom and bust California period, but also in every migration boom and bust period. Most speculators get wiped out. A few survivors with low leverage and patient capital eventually thrived because San Francisco's geography created permanent scarcity as the city grew. So, fast forward 170 years to 2020, to our own current modern gold rush. A new rush had begun, except instead of precious metals in California, it was a population growth story in Texas, Florida, and Arizona. And this story was compelling. They're always compelling. The stories are always compelling. Tech companies fleeing California, crazy, wild politics and the COVID era lockdowns, and everybody had to get the heck out. Remote work was going to eliminate geographic constraints, and everybody was going to be able to work from wherever you wanted to work, and it was going to be awesome. There was no state income tax. There was this explosive growth story happening, and everyone from Elon Musk to Joe Rogan was making the move. The inevitability felt overwhelming. Austin was the next Silicon Valley. Miami was the new Wall Street. And just like 1849, we got the same three groups. We got the migration chasers, the fast money, coming in, trying to buy it up, trying to play. This is not a perfect metaphor, by the way, or analogy. I don't know which one I'm looking for. Analogy, metaphor. It's not the perfect one. I'll tell you why. Because no one here is pursuing a resource like gold, right? So we have like two different kinds of real estate investors, but you have these migration chasers, right? Point being there. Fast money, new syndicators, sponsors fresh out of their training class with their some guru that they paid, and they're going to go out and buy a 150 unit building and they've never done a building before. Austin multifamily cap rates dropped to 3.25%, among the lowest in the nation. And what you got to realize about that is that buying at that cap rate, you're basically paying prices 6 years in advance of the price you're paying because you believe so much in the growth story, right? So much. Second group, the infrastructure builders. Amazon, Tesla, Oracle, they relocated. They built facilities. They created real economic activity. And they will be fine, right? Because they can get away with paying people less, and there's some benefit for them for doing it, plus taxes, right? Also, my favorite investment firm that I worked for, Fisher Investments, also happened to move to Texas. So the growth story for the economy is real, right? It's real. It drove this boom. The third group are the real estate owners. And this is where the story diverges slightly from 1849, because unlike Gold Rush San Francisco, the Sunbelt had and has unlimited land and elastic housing supply. And just like the California Gold Rush, the Sunbelt migration created its own collapse. The data tells the brutal story. And I will drop a link in the comments for this article for this particular article, but also another article we wrote on the Timeless Investor, which really dives into this supply versus constraint story. Make sure you check it out. Subscribe if you haven't already to the Timeless Investor on Substack. We dive into this sort of stuff constantly. I love it. So what does the data tell us? Phoenix issued 58,000 residential building permits in 2024, a 23% increase over the 3-year average. Austin, rents are now down 15% from peak. Home values are collapsing. Tampa and Miami, transaction velocity collapse. UBS just identified Miami as the most likely market to collapse in the world. Okay, in the world. And by the way, home prices in Florida are collapsing. People are trying to get out. It's a problem. Insurance premiums are spiking. It is a serious issue. So by 2023, the migration story was over. Remote workers moved back to coastal cities. Interest rates spiked. Insurance costs exploded. Deals fell apart. Keys got handed back to lenders. The inevitable Sunbelt boom became another real estate correction. This pattern repeated exactly. Migration chasers lost everything. Infrastructure builders survived. And well-capitalized, prudent investors who made the right pick are going to be fine. But here is my opinion, the biggest problem, and something that is missed in this whole coastal versus, middle of country debate. San Francisco in 1849 and today, by the way, has massive geographic limits. It is a peninsula surrounded by water and mountains. Even in 1855, when the city was brand new, the geography was fixed. As the city grew over the subsequent decades, building became increasingly expensive and difficult. Supply became permanently constrained. Austin in 2021 has unlimited land. Texas has liberal zoning, cheap land, pro development culture. So when demand spiked, supply responded quickly through overbuilding, strong supply elasticity. Both Gold Rush San Francisco speculators and Sunbelt investors made the same bet: buy real estate during a massive migration boom. Both groups included smart, sophisticated investors. Both groups got crushed when the boom ended. The difference was not their intelligence, it was geology and zoning and the markets they chose. Gold Rush survivors who held for 10 to 15 years eventually recovered because San Francisco couldn't expand and the city did continue to grow, especially once the Transcontinental Railroad was completed. Sunbelt investors who survived the current crash, in my opinion, will face a much longer and weaker recovery because Texas, Arizona, and Florida can expand forever. And we have 100+ years of history to tell us that Florida is a boom bust market. You got to get in at the right time or you're going to get your face ripped off. One of my favorite finance terms. Get your face ripped off. It'll happen. Okay, so here are the 3 timeless lessons to take from the story of the gold rush. 1, betting on migration booms is inherently risky. Most gold rush speculators went broke in 1857. Most Sunbelt investors are deeply underwater right now. If you're going to make this bet, you need low leverage to survive a 50 to 75% crash. Because remember also, leverage massively amplifies your losses. You could take a 20% loss to the value of the building, but if you're, I don't know the exact number, but if you're levered, you will lose 100% of your equity, right? You have to have patient capital to hold 10+ years and a supply constrained market. So I think recovery is actually possible. 2, supply constraints help determine recovery. Gold rush survivors weren't smarter than the speculators who went bankrupt. They got lucky choosing a geographically constrained market. Then investing heavily in some California town near a gold strike that disappeared. Your real estate investment would have just vanished completely. There is no value in that land once the core use is gone. San Francisco, it's a permanent supportive harbor. It's the gateway to the Pacific. 3, infrastructure multiplies, extraction depletes. Gold mines do get exhausted. Ports, universities, transportation networks compound value over time. San Francisco survived because it became permanent infrastructure for the Western United States. The gold rush ended, but the city remained. And it remains to this day, and it is an important and major global city. So the California gold rush lasted about 5 years. Most real estate speculators went bankrupt in the crash. The survivors built generational fortunes, but because San Francisco created permanent scarcity over time, and it was a very important city, the Sunbelt migration boom lasted about 2 years. The overleveraged are going bankrupt there right now. The survivors who can hold for 10+ years will probably recover, but I still don't love the market dynamics because you have no supply constraints. Both groups made risky bets on migration booms. The difference is not intelligence. Timing is relevant here, but it is not intelligence, but it is also geographic constraints to the land. The miners kept looking for the next big strike. The smart real estate investors don't avoid migration booms. They just make sure they control their leverage, their timing, and investing in materially important and supply constrained areas. History, in my opinion, is pretty clear about which geography wins in the long run. If this clicked for you, hit subscribe. Again, check out in the comments the show notes and the links to several articles that I will link that dive deeper into this deep data analysis on supply constrained markets, investing in risky, I'm using air quotes, risky blue states, risky coastal markets that are severely supply constrained. And as always, think well, act wisely, build something timeless. Thank you.